Well, compound interest is a concept that you may or may not be familiar with, but even if you don't know how it works, it can make the difference of hundreds of thousands of dollars in retirement money in your golden years. So Ken Grant with Waterstone Private Wealth Management is with me once again to talk about how a relative little can go a long way in both the positive and negative aspect. Good morning.
Good morning. Good morning.
Well, I want to start with the positive. So we've seen a lot about interest rates, how it's making it more expensive to own a home, buy a car, get a car loan. Let's talk about compound interest. How do you explain it to your clients?
Okay, well, anytime that you take out a loan, there's going to be interest on it. You take out a credit card, there's interest on it. So that's why it's important that you watch what is happening with interest rates. They have been rising, and while that's scary because they used to be at zero, now they're still at historically pretty low levels, so people are still spending. The problem is, you pay interest on a daily basis, but you pay your credit cards on a monthly basis. Well, hopefully you do. If you don't, then they'll shut them off. So we're always then accruing more and more debt when we then put things on a credit card. So the important thing is to be able to pay that off. Never put something on there that you know you can't pay off in short order. If you put it on there, and let's say it lasts 5 or 6 years that debt sits on there, you're going to pay exponentially more because of the negative effect of compounding interest. The interest you had on the first loan, then collected more interest, collected more, and you're paying a much bigger price for that car or refrigerator or whatever
TV.
It is, TV, whatever it is you bought.
We're going to get to the credit cards in a minute, but your team has put together some great graphics. Tell us what we're looking at here on graphic number 1 about interest and the power of compound interest here.
So if you look at that, then it's showing what your initial investment is, that bottom gray line, but the simple interest that is added to it over time, and this is looking at a 20-year period, then shows that $1,000 is really about $2,000. But because interest is on there, simple interest, it's been compounding, and really now your debt is closer to almost $2,700 for that $1,000. So it more than doubled what your expense is. Now, if that is because you are paying interest and paying off the debt, that becomes negative. That's why people get caught in that negative loop of, not being able to pay off their credit cards.
Right.
On the positive side, if you are earning that kind of simple interest that then compounds, then you then multiplied your savings that way.
Yeah, and so the compound interest is something we're going to want to be earning and not paying.
Always,
very correct.
Albert Einstein said the most amazing mathematical phenomenon he ever observed was the power of compounding interest over time.
Yeah.
Those who understand it earn it, those who don't pay it.
Ouch. Boy, he had a lot of good nuggets, didn't he? In investing earlier in life is better because it's hard to catch up in those final years leading up to retirement. So you have another graphic here that shows, boy, the difference between that gold line if you're starting to invest at age 30 versus that black loop when you're starting at age 45. It's almost impossible to catch up for that loss.
Yeah, so anytime people see graphs, a lot of people's eyes glaze over. It's really important to understand this. This is over time. So that if you started, when you were 30 and you were putting $850 a month, maybe a typical car payment, maybe a typical house payment, something you normally would be putting in debt, but yet you earned 7% interest on that, and that interest kept compounding year after year. By the time you would go to retire, you're a millionaire. That's how you become a millionaire, is saving over time, not winning the lottery, not one big payday. It was saving over time. Now, if you didn't start early, you started later, that's what the black line is showing. You still save, but now you have to double your savings, almost $1,700 a month, to then save $306,000 by the time you retire. But it had grown, congratulations, to $500,000.
Right.
That could make a big difference in your stability and your sense of security in retirement. Is how long have you been saving? That's the #1 key, not how much, but how long.
How long? And like you said, that $850 a month, that could be a house payment, that could be a car payment. One more thing, just going over the credit card thing one more time, because I think this is really important. Folks may not know how credit cards work, but again, you're talking about $1,000. Let's just say I buy this new TV for $1,000, and then I don't pay it off. We're starting to get in trouble here.
Yeah, so as you see in the graphic, there's the $1,000 balance. The total interest that you ended up paying would be $568.
If your credit card is like a 20% interest rate, for example.
So the answer is, when you saw that TV, it wasn't a $1,000 purchase. It's a $1,500 purchase.
Right.
If you are informed then you can decide what size TV. Maybe I need a smaller TV. No, I can afford a $1,500 TV. But most people then, we're Americans, we want more. We get the $1,500 or the $2,000, well now it's maybe over $3,000 that we paid for that one item.
Oh boy, well Ken, thank you so much for this great advice, and this was great. So Ken Grant with Waterstone Private Wealth Management, we appreciate your time today, as always.
It's my honor, thanks.